There is heaps and heaps of negative media out there at the moment around interest rate rises, the coming Armageddon, small property price declines that are expected. Now, instead of buying the hype, what we decided to do was go back and look at what history has taught us and what the relationship between interest rates and property prices looks like. Now, in this one, it's packed with gold from the likes of CoreLogic, CBA Bank, as well as our mate over there at Untitled Ryan. Super excited. And what we found is that the correlation is extremely different to what the media might have you believe right now. Come take a look.
Now, after going back and looking at over 30 years worth of data, what was the biggest takeaway when looking at the correlation between interest rate movements and property prices?
Sure. So from the likes of CoreLogic, CBA, Simon Pressley and Ryan from On Property, basically the consensus was really, really clear, and it was much clearer. So the first lesson that we learned is that as interest rates decline, property prices go up. It's almost an immediate trigger or lever that they can pull globally that has had a really positive impact. So I read an incredible article from CBA Bank and CoreLogic that suggested for every 1% decline in interest rates, it results, if that interest rate is held for more than 12 to 18 months, in about a 15% increase in property prices. Now, when people go, well, why did property prices in 2021 go up 30%? Because in the years leading up to that, we went from a 4.5% interest rate to a 2% interest rate, and therefore 2% drop in interest rates, 30% increase in prices.
That obviously makes a lot of sense as well. When interest rates come down, affordability goes up and people spend a little bit more money and hence stimulates the economy. But the second thing that we learned was just as fascinating as well. Let's go into that.
Yeah, so because the correlation on reducing rates and property prices going up, I thought then there'd be the opposite relationship, which is, well, as soon as interest rates start going up, is there a decline associated with it too? Now, Ryan from On Property was the first one to send me some information that he'd looked at with Jeremy Shepherd from DSR on this, and what he found was that there wasn't a really, really strong correlation. Then Simon Priestley had backed that up in some recent articles on his website, and then looking at what CBA and CoreLogic had to say, it wasn't as clear. So I think there's two things that negatively impact property prices on the decline. One of them is sentiment, and that's the major driver. The second thing that seems to me to affect property prices more than anything else is just having a ridiculously strong year the year before or a couple of years before that, and then people going, shit, I don't want to overpay by $100,000 next year, and the market sort of naturally pulling back. And that's why we're seeing the likes of Sydney and Melbourne particularly pull back at the moment. Sweet. So obviously when we looked back at the numbers, like what had happened in previous cycles and during previous histories of interest rate increases or decreases in Australia.
Well, what we've done is we've looked back at the numbers and put some information down here, but then we've also referenced the 18.6-year real estate cycle as to where we were at that point in time, because that has a major impact on property prices as well. So the furthest back that we went was from 88 through to 89, where interest rates rose from 14% to 17%. And over the same period of time, the median house price for Australia rose 35%. Now, it's important to recognise that at this stage of the cycle, it was the top of the real estate cycle at that point in time. So generally, when you get to sort of the very end of the cycle, the very top of the cycle, you start to see really positive property price gains as well. And then what actually happened immediately after that, from 1990 through to 93, is they realised property prices had increased way too fast, and they actually pulled back rates from 17% back down to 9% over that 3-4 year period. Now, the funny thing is here is there was actually no meaningful changes to property prices over that period of time. Now, this was actually at the end of the cycle during that declining phase. So obviously property prices got so hot, they tried to rise interest rates to stop the property prices from going so high. They got them too high, they needed to pull them back, and nothing actually ended up happening with property prices when they came back over 8% at that point in time.
Which you'd expect to happen because at that particular stage is sort of the 3 to 4 years down at the very end of a cycle, like a GFC style event. That was actually the GFC before the last GFC. And so 0% growth in a time where the stock markets at that point went down 50 to 60% and house prices in America went down by between 15 and 30%, was like Australia saving our ass somehow again, because like it should have looked negative at that particular time, to be honest.
Yeah, and it did around the world for sure. And then you go into sort of 96, 97, where rates fell another 4%. And over that period of time, the median house price went up about 10%. Now, that was sort of during the first half of the real estate cycle at that point in time. Then during 2000, 2001, that was sort of the mid-cycle slowdown of that previous cycle. And then the second half of the cycle really began in 2002 and ran through to 2008. And this is where interest rates rose 22 times from around 5% to around the 8% range. And this was when Brisbane property prices went up by 127%. 6 out of 8 capital cities all doubled in value over this period of time. Every single market in Australia except for Sydney and Melbourne doubled in value over that period of time. Now, the interesting thing over this 6-year period, the median house price of Australia actually looked pretty flat. It actually looked like it didn't move. And I think this is a really important thing to talk about, because we're in a very similar time right now in the current real estate cycle, with Sydney and Melbourne underperforming, the other areas around Australia starting to perform well. But because Sydney and Melbourne are such massive markets, they have such a huge impact on the Australian median house price. When you can have 6 out of 8 capital cities more than double in value, but the median house price still sat flat over that period of time. That was absolutely fascinating to me.
Yeah, well, I suppose Sydney and Melbourne represent 70% of Australia's real estate value. And then between that period, I think 2002 to 2008, Sydney prices went up 29%, Melbourne prices went up 66%, and then every other capital city during that time did over 120%. It's just really interesting. So when I look at like top headlines, which is like Australian property prices declining, if Sydney and Melbourne are on the decline, which they did in 18 and 20, then Australia is on the decline. If Sydney and Melbourne are going through the roof and increase by 20%, then Australian property prices also go up by 15 to 20%. And it's important to start being able to differentiate big level numbers with what's really going on. Now, where I see the commentary at the moment failing in the media is around interest rates, is not factoring into the position of the real estate cycle that we're in, and not being able to separate what's going on in Sydney and Melbourne with what, and I put, to be honest with you, a whole bunch of other markets in there, Canberra and Hobart too, because they've had an incredible run, versus what's going on in Adelaide, Brisbane, Perth, and some of the other major regionals that have yet to go through this 100% growth in the last 10 years. And when you start to break Australia up in that way, there is big opportunity in the next 4 to 5 years for smart investors that know how to rip apart a market.
Exactly. Like, you just need to understand that Australia isn't one single market, and at any point in time, whether interest rates are going up, down, or sideways, you know, there will be suburbs, there'll be markets around Australia that will also go up, down, and sideways. So you've got to understand how certain markets perform at different stages of the real estate cycle. And when you look at the positive property price growth in Melbourne, Sydney, Canberra, Hobart over the last 10 years, it makes the Australian property market look like it's been performing extremely well. So when the media jumps onto that, they go, Australia has been booming, Australian property prices have been booming. But then when you go into the market level and you look at the property performance in Perth, Adelaide, Darwin, Brisbane, over 2010 through to 2020, and all of those markets basically sat completely flat over that period of time. And property prices in 2020 were more affordable compared to 2020 in most of those markets once you factor in inflation. So, you know, it tells you a really different story. And I think that's what we want people to get out of today's video, is that Australia isn't one big market. Sydney and Melbourne have been cranking, and people have made amazing amounts of money there over the last 10 years. And kudos to everybody that got to experience that. But now, obviously, interest rates are coming up because they couldn't sit where they were for a long period of time. The RBA has constantly adjusted interest rates depending on economic conditions. So now that they feel that we're in a more stable position and they want to hedge against inflation, those interest rates are rising, which will impact markets like Sydney, Melbourne, Hobart that have doubled in value over the last 10 years. But how much they'll impact markets like Brisbane, Adelaide, Perth, based on history, we don't really know, but there isn't much of a correlation there.
Yeah, I really appreciate that insight, man. And what's interesting with history is we can't predict the future, but we can get this concept of remembering the future. So looking back at the past. And when we know why the government's pulling interest rates, it's pulling it back at the moment to slow inflation, to get spending under control again because property prices have been running away. When it reduces interest rates, it's trying to stimulate spending, it's trying to stimulate property price growth to make us all feel wealthy and spend money again. So it's like that's what they do. There's other levers that they pull too. But we hope this information has been valuable. We hope you're not losing sleep over a 1.5% interest rate, especially when you look at the notes from the Reserve Bank and they're expecting to actually drop those rates again by the end of 2023 or definitely 2024. So this is an inflation exercise. It's not a interest rate exercise at the moment. For those of you that have enjoyed this video today, please like it. Please give us a comment. Obviously, there'll be those of you that don't agree with what we're saying. That's completely cool as well. Love to see that feedback. And for those of you that have friends that are struggling with this at the moment or that are getting scared for no real reason, please share this video. But either way, we wish you all the best and all the safety on your journey as an investor.
Whew, that's a wrap.
That's a wrap.
Getting
Have a spin.
bro. Yeah. Oh, sweaty. So sweaty. Oh, that's good. Look at that.
So nice, eh?
Oh.